We'll talk about dividends. And the common rule is that for the maintenance of the capital, dividends cannot be distributed out of that capital. The money that we paid for the shares cannot be again be distributed to us as dividends. Capital is never used to pay dividends. Dividends are paid out of surplus profits. This means when the company is not making a profit, it does not declare dividends. So dividends only arise where there is that element, the company performed extremely well, the company was able to pay its obligations, and an amount has remained behind for distribution. And these are accumulated realized profits, not previously utilized by distribution or capitalization. You net the losses, and it can be only paid out when realized profits exceed realized losses. But it is not just paid, it has to be declared. And a meeting is called whereby the company's book of accounts are examined by the shareholders. The directors will propose, and by ordinary resolution, declare dividends. The directors will, so the amount proposed by the directors cannot be, if the shareholders disagree, they can agree on any amount, but it cannot exceed what has been recommended by the directors. So the directors, as a matter of management, decide how much should be paid out by way of dividend, how much should be retained and invested back into the company. And this means if the directors knew there was no power to pay dividends and they went ahead and declared and called a meeting, they will be liable. But if they acted honestly, relying on their accounts, then they cannot be liable. So how do we pay dividends? Once it is declared, it's a contractual debt owed to the shareholders. Again, remember, it's declared at the AGM that this company for this year has been able to pay off all the debts, and we have this much money, so we are proposing a certain percentage to be retained by the company in running its operations, but dividends be issued at 10%. It becomes a debt owed to the shareholders. So what are the rules? We have said can only be paid out of profits, not out of capital. The resolution must be passed at the AGM. It cannot be declared if it would result in the company being unable to pay its debts. So these are the surpluses. All debts have been paid, and it's only payable in cash. And we have a dividend warrant where the registered members will be sent that warrant, which consists of two parts: the advice informing the members of the particulars of payment, and the warrant proper, which is a check that directs the company's bank to pay the sum due to the member. So this warrant shows the amount of dividend or interest paid and the tax credit. You'll normally find an envelope addressed to you as a shareholder. And in this envelope, it has two things. There's the check you'll take to the bank. There's an advice that shows the number of shares you own, the declared dividend, the tax paid, and the net amount due. This net amount due matches the amount on that check that you'll take to the bank. So the check is normally signed, again kept for 6 months before or longer, depending on what has been provided for. We also have dividend mandates. So where you as a shareholder, probably, you do not want these physical checks, you can direct the company to pay directly to your bank. And the company provides these forms. This helps the company reduce the amount of unclaimed dividends. You see, at times, you may find the registered post office box you used when buying the shares. You moved from a place, you forgot to change your address, or you moved jobs, you changed jobs, again, forgot to change your address. So your dividends are sent to your last known place of residence or business. So each year, you're not able to cash, you're not able to bank these checks. So what do you do instead? You write to the company, instruct them that you don't want checks, you want the money paid directly to your account. It's okay, it's permissible. So we also have the capitalization of profits. That is, instead of paying out cash, instead of paying out dividends, you're given further shares that are wholly paid up or partly paid up out of these profits. And the amount paid by the company on account of these newly issued shares, they're known as bonuses, and these are bonus shares. Again, it's decided at the AGM at the recommendation of the directors. So the bonus is provided out of the credit balance of the profit and loss account. So it shows the profit at a reduced figure, issued capital increases. And this process reduces the risk of any person gaining control of the company and distributing the liquid resources of the company against a reduction of the profit and loss account. If the profits have been capitalized, the assets can only be distributed by way of capital reduction, which requires a special resolution and confirmation by the court. So what are we saying about capitalization of profits? You're not issued a dividend. Instead, you are allotted further shares or debentures. And what this means, the paid up capital of the company increases, while the amount due for distribution reduces. So what do we call these shares? We call them bonus shares. That is how they come about. That the directors recommend, instead of paying out dividends, why don't we issue bonus shares to the shareholders, thereby increasing our capital reserve, reducing the amount available for distribution. We have come to the end of chapter 5. That is the share capital.